Today I'll be looking at how to minimize taxes on $2.8 million in pre-retirement savings when you're approaching retirement at age 61. As an advisor who helps many people safely retire every year, I've developed specific strategies that significantly reduce their tax exposure while maximizing retirement income. That's exactly why I'm making this video today, to show you how to protect your $2.8 million pre-tax savings from excessive taxation. So let's get right into it. It's pretty common for folks when they're retiring today to either have most of their retirement portfolio or even sometimes all of it in pre-tax retirement savings. That's been the most common retirement savings vehicle. So for somebody in that situation, you're kind of faced with, maybe not as many options compared to someone who has money saved in brokerage accounts. What I mean by that are, after-tax investment accounts, or a lot of money in just cash savings or Roth accounts. And so what I want to do is, in this video, demonstrate what are some of the tax strategies that somebody could use if you basically have all of your money in pre-tax savings. So we're going to look at a case study of Jeff and Margaret. They are 61 years old. They're going to retire. They live in North Carolina. I included that because state taxes are always part of this equation. So I like to factor in state taxes when, with these examples. So for this scenario, I guess, first of all, I'll talk about some of the tax strategies that you can use. So for this case study, what I want to look at is somebody who has the majority of their money in pre-tax savings accounts. So that's the most common type of retirement savings vehicle. And so when you don't have a lot of money already in Roth accounts or after-tax brokerage or savings accounts, it can be quite difficult to do most of the kind of fun tax strategies to have a more tax-efficient retirement income. So if you're in this situation where you basically just have a large portfolio in pre-tax savings and you have Social Security, what are the planning opportunities available to you? So let's break down what some of the strategies are, and then I'm going to apply it to this case study so you can get a good sense of how this might apply in your situation. So the numbers obviously are going to be different with your situation, but hopefully from this you can glean some good ideas. So number one is I would break down the tax strategies into kind of phases of when you would use them. So the first phase is, let's look at early retirement. So for this couple from 61 to 65, what are some of the things they can do in that time frame that are kind of best suited for them? And then basically after age 65, and then especially after age 70 and a half. The major kind of low-hanging fruit tax strategy for somebody before age 65 is to contribute to a health savings account, an HSA. Now, when you contribute to an HSA, you get a tax deduction for that contribution. And what's very important for an early retiree, you do not have to be working to contribute to an HSA. Now, that often gets conflated with IRA or 401k contribution rules. With those retirement accounts, you have to have earned income. So you can't just pull money from an investment portfolio and put it into a retirement account if you're not working. But with an HSA, yes, you can, as long as you have a high deductible health insurance plan. So the contribution amounts are not massive, but we're talking, what are the tools? What are the things that are available? This isn't a massive thing, but it is available. So, you have to be aware and see what impact it'll have. All right, so the contributions that you can make to a health savings account, they're not massive, but this is an available tool. So if having a high deductible health insurance plan, makes sense for your situation, I'd say that's the primary consideration, then, you might as well be taking advantage of that tax deduction. So I've got the numbers here for 2025. For an individual, you can contribute $4,300 into that HSA, and for a family, that's $8,550. And also, you've got an extra $1,000 of catch-up contribution. For an individual, you can contribute $4,300 for the year. For a family plan, you can contribute $8,550 with an extra $1,000 for either plan if you're over age 55. So very helpful. And is this going to change? Is this going to be monumental? No, but if you're going to have to be, paying for a health insurance plan and it makes sense given your situation, then, you might as well be taking advantage of this. And this is a common tool I see underutilized for early retirees because, like I said, they often conflate the rules between health savings accounts and retirement accounts like IRAs or 401ks. You do not have to have earned income to make these contributions. And so it's a great tool for tax savings for somebody with a heavy pre-tax portfolio, going to have to be saving for retirement anyway, or is going to have to be paying for health insurance and that sort of thing anyway, to utilize this tool. Now, the second tax planning strategy I want to go over is something that you've probably heard a lot about, and that is a Roth conversion. So Roth conversions, very simply put, plenty of videos on that, but for our purposes today, I'll keep it straightforward. So with a Roth conversion, you're taking money from a pre-tax account like a 401k, 403b, IRA, and you're taking it out of the account, moving it into a Roth account. And when you make that transfer and move over, you have to recognize the income, pay taxes, or it gets reported as taxes. But now going forward, that money is within the Roth account growing tax-free, or I should say the potential to grow tax-free, but it's tax-free, and then what's in there going forward. So it's a great tool for tax planning throughout retirement. Now, one thing to note here, I often, when I meet with folks, they'll confuse Roth contribution limits with Roth conversion limits. So there are contribution limits, how much you can do in a year. There are no conversion limits. So you could convert $1 million from an IRA over to a Roth in a single year if you wanted to. Now, obviously, by doing that, that would be taxed at a much higher rate than if you were to spread that out over time. But there are no conversion limits. So it's a powerful tool. And when you're looking at Roth conversions, what you're basically saying is that you believe your taxes now are lower, even with the conversions, they are lower than what they are likely to be in the future, or the rate you're going to pay is lower now than what it'll be in the future. So you're saying, I'm going to go ahead and kind of prepay taxes on my retirement money because I figure if I do it now, I'll pay a lower rate than I do in the future. So there's a lot of, obviously, for you to have a good sense of whether that's going to be true or not, you really have to map out your retirement cash flows from the beginning to the end to have a good sense of kind of where you're going to line up within the income brackets. Now, tax law can change. That's always a consideration. But usually what I will do is look at current law and map out a cash flow plan for retirement under current law, and then and see how things kind of shake out. Then from there, you can kind of speculate or think about, okay, what's likely to change? Could rates go up? Could rates go down? That sort of thing. But first, just map it out under current law and see, is there kind of an obvious opportunity where your rates are lower than they're likely to be far in the future? And so if that's the case, you're saying, yep, I'm going to go ahead and prepay some of my taxes now so that when I have the money later in retirement, I'll be able to take it out and avoid paying a higher rate in the future. So there are some kind of dynamics of a retirement plan that kind of favor, in my opinion, doing more Roth conversion versus not. So anytime where I would say, number one, you have the expectation of rates to be much higher in the future, then it would make sense to do conversions now. So this can be winter situations like that. Number one, if you are currently married and in the future, your spouse, wife or husband passes away, and you continue to live for an extended period of time, you now go from, married filing jointly down to eventually filing as a single filer. And when you do that, the amount of income that's available within all of the brackets is going to go lower. So you're going to automatically jump into higher brackets, most likely. I haven't talked about it yet, but the amount that you pay on your Medicare Part B premiums is also a function of your income, and so the rules that pertain to that also have income brackets. And so if you expect like, hey, I'm going to be a young widow, I'm going to leave my spouse, and they're going to be a young widow, then even if you expect kind of your current tax rates to be roughly the same throughout retirement, if there's a good expectation that you're going to go from a married filing jointly to single filer status in the future, then that might kind of lean the scales towards doing more Roth conversion now while you're in that married filing jointly status, because rates, you have less income available at each of the bracket levels. Another consideration that would kind of tilt the scales towards doing more Roth conversion is if your amount of income that you think you're going to need is mostly or entirely going to be taken care of by Social Security income. And that is because if most of your living expenses are covered by your Social Security, your future Social Security benefits, then what will likely happen, what I've just seen in my own experience working with lots of retirees is that you kind of hit these, you have go-go and then kind of the slow-go years. During the slow-go and the no-go years later in retirement, you're doing less and you're living on your Social Security benefits in this example. Then if you have a large pre-tax balance, it continues to grow. You're forced to take out larger and larger required minimum distributions, and you're not spending that money. And so it's just kind of forced taxation. You're taking it out, you're not spending the money, and it's taxed at higher rates. And in the future, so for example, let's say later on down the road, you say, my goodness, my required distributions are so large, I'm going to do some Roth conversions now. Well, the good news is, yes, you can. The bad news is that doing a Roth conversion later in retirement when you're at that age, the Roth conversion doesn't satisfy the required distribution. Let's say you had a required distribution of $100,000 and you wanted to do a Roth conversion of, some amount, $50,000. Well, you couldn't just do a $50,000 Roth conversion and then take out another $50,000 to satisfy your total required distribution. First, you would have to take out a full $100,000, satisfy the required distribution, and then from there, do Roth conversions to your heart's content. So it's going to be easier and probably more affordable to do those Roth conversions early in retirement, as well as to compound that tax-free growth versus doing it later in retirement where you're forced first to satisfy the RMD, then do the Roth conversions. So that's something to consider. Another consideration of doing Roth conversions is the impact of your level of income on your Medicare Part B premiums. If you're not aware of this, when you are on Medicare after age 65, you have Part A, which is tax-free, or I should say you've been paying for it your whole career. And then Part B, you pay a monthly premium. Now, that'll come out of your Social Security check after you are receiving Social Security income. But if you're delaying Social Security, you'll still apply for Medicare, and that Part B premium, you'll just pay that directly to Social Security Administration. So the amount you pay for that premium will vary based on your income level. And so I'm going to show you a table here so you can get a sense of kind of what that looks like. All right, so over here on the right-hand side, this table shows the different brackets for in 2025, how your Part B premiums are impacted by your income level. All right, so first of all, you'll notice here this says 2023. This is not on this sheet. That's not an accident. With your Part B premium, it's actually determined by your modified adjusted gross income from 2 years previous. So the Part B premium you pay in 2025 is driven by your MAGI from 2023. So you can see the brackets here. So first of all, your baseline premium that you're going to pay is $185 a month. Now on top of that, you'll have you might have a Medicare Advantage plan or a Medicare supplement. That would be in addition to this $185, but this is the baseline expense you're going to pay. So if you're married filing jointly, you can see these brackets, they're pretty generous actually. Modified adjusted gross income, MAGI of $212, you're just going to pay that baseline price. Now you can see between $212 and $266, you'll pay an extra $74 per person. Between $266 and $334, pay an extra, your rate doubles. And you can see for the very, very high annual income levels, you are going to pay an extra $440 per month per person. So just to be aware of, but I think right here, this kind of highlights potentially some of the issues with doing massive Roth conversions, later in retirement is that you could, get up into these levels where you're paying higher Medicare Part B premiums. Now, keep this in mind that 2-year look back, it's a rolling 2-year look back. So your 25 premium is based off your income in 23. Your 26 premium is based off your income in 24 and so forth. So if you had a really high income year, well, you're going to have, one high year of Medicare Part B premium. And then if your income drops, then your Part B premium will also drop as well. I bring this up because it's something to be aware of for married filing jointly, but especially for a single retiree or for the potential widower, is that you can see that all of a sudden, where you could have $212,000 of modified adjusted gross income and only pay $185 a month for your Part B premium, at that same income level, let's call it 212, you are already, as a single filer, you can see this bracket level, between 200 and 500,000 of MAGI, you are already paying an extra $400 per month for your Part B premium. So not only are you in a higher tax bracket, but also you're paying an extra $400 a month, what amounts to, let's say, $406 a month, I don't know, roughly an extra $5,000 a year just for your healthcare. It amounts to an extra tax, right? So this is very relevant, especially where you have a retirement portfolio of a large amount of pre-tax savings. And so let's say one spouse dies, okay, well, you're going to lose one of the Social Security benefits, the lower of the two. But now what's going to happen is you have the larger Social Security benefits still in place, and you still have that large pre-tax retirement portfolio. And although the widow or widower may be able to live on a lower income, they will be forced to take a higher income because of required minimum distributions. And this is where taxes become very, very high for a widow or widower. So this is something that kind of can influence or impact your decision to do Roth conversions early in retirement versus not. Even if you think, you know what, the rates, maybe they're going to be a little bit lower in the future compared to what they are now based on your projections as married filing jointly. But as a single filer in the future, you go, wow, it'll be a lot more expensive. So in that situation, you could see yourself kind of making an informed decision to do more Roth conversions, and maybe you need to, per se. There's no like perfect right or wrong answer, right? Like I say, after we're all dead, we'll be able to look back and be able to see maybe what was the mathematically perfect way to structure your retirement. We can't do that today. We have to just make decisions in real time based on the best information that we have. So anyway, hopefully that's helpful. The last thing that I want to go over, the last strategy, and then I want to kind of just compare these two scenarios. And this is really the strategy that I want to model within the software, is whether or not you do charitable contributions. If giving to charity, to public charity, is something that's already kind of part of what you do, or it's something that you plan to do when you're retired, there's a lot of tax planning opportunities for somebody in that situation. So with retirement accounts, there's a special provision that allows you to make a transfer from your retirement account, from your IRA. Actually, it has to be an IRA. It can't be a 401k or 403b or 457. It has to be an IRA. You can make a transfer tax-free from that account to the public charity of your choice. The only stipulation is it has to be a qualified charity, a public charity, and the money has to go directly to them. So it can't you can't take a distribution from your IRA into your checking account and then write a check to, your church or the food bank or wherever and have it qualify. A check can come to you, but it has to be made payable to the charity. Okay. So the benefit of that is that when that happens, that charitable contribution actually counts against your required distribution. So like we talked about the widow who's kind of doesn't need a lot of income but is forced to take a lot of income because of required distributions. Well, now this is a way where that person can actually lower part of that required distribution by transferring it directly to a charity. And what's important about this is where you get the tax deduction. With a normal charitable contribution, like just during your working years, that contribution is recorded as one of the itemized deductions, what we call a below-the-line deduction. And first of all, you only get a tax benefit if the sum of your itemized deductions exceeds the standard deduction. But also, when you take a itemized deduction, it does not impact your AGI or your modified adjusted gross income. Now, why is that so important? Well, the reason why that's so important is because your Social Security taxation and your Medicare Part B premiums are driven by your AGI or MAGI. So where possible, you want to get tax deductions that are what we call above the line, And so when you transfer money from your IRA to a charity, it reduces your required distribution. And so it effectively reduces your modified adjusted gross income for regular income tax, but also for purposes of calculating how much you pay for Medicare and for how much your Social Security, how much of that is going to be subject to tax. So it is it has the potential to have an outsized tax benefit, just, beyond just the impact of, less income being taxed. So where this is something that you were going to do anyway, you like to donate to charities, or you think, maybe there's some things I might want to get involved in. It's a great tool that you can use to do something that's important to you and save taxes. There's one last consideration I want to talk about with tax planning and retirement, and that is taking a multi-generational view. When you are planning for retirement, you can think about taxes just at your own level, if you're single or with your spouse, partner, or that's one level to think about it. Or you can think about it even, eventually, if you have a large portfolio, if you have children, that some of that money is probably going to go to them. That's what happens most of the time. And so if you think about tax planning from a multi-generational standpoint, kind of the best practice here is if you are going to leave money to your children, from a tax planning perspective, you can think of what is your bracket and then what are the likely tax brackets of those future beneficiaries. Now we're already kind of speculating for 61-year-olds what their tax brackets are going to be when they're 80 or 90. Which is already kind of a how much precision can we have? All the more so when we're talking about, your beneficiaries, many, many years in the future. But one general principle is that if you have multiple children and your portfolio would be basically, let's just say it's divided among all your children equally or some method, then probably, or it's reasonable to assume that if you take that portfolio and divide it among 3 people, 2 people, 3 people, 5 people, that they are likely to pay lower taxes on that money, on that pre-tax money. Because when one of your beneficiaries receives a portion of your IRA, they will have to take that money out of the IRA. They have 10 years to do it. But if they're only dealing with half of your retirement money, or a third, or a fourth, or a fifth, you can see where all of a sudden that money will potentially be distributed at lower tax rates. And so there's kind of this generational tax arbitrage, if you will, where let's say mom and dad are at a higher bracket, and then collectively the kids, as that money is dispersed 5 ways, and they eventually distribute it, that the overall, the weighted tax rate that you pay is going to be lower versus higher. So that was kind of a lot there, but kind of a high level idea. So now what I want to do is I'm going to pull up this retirement scenario, and we're going to look at the impact of doing qualified charitable distributions, comparing 2 retirees. So we have Jeff and Margaret here. They have a budget, their planned spending of about $12,000 a month. And for this retiree, they're not planning on doing any charitable contributions, anything like that. So I just wanted to show you kind of the income sources here, so you have a sense of what's happening. In the beginning of their retirement, 61, all of the money's coming out of the portfolio. As we go through time, you can see that we have Margaret actually in this example claiming her Social Security early because she has the lower benefit of the 2. They both qualify for a benefit. We go along, get to 70, Jeff takes his, and so we go along here. Now, looking at expenses, for this plan, they just have we're just planning for an adjusted for inflation $12,000 per month as they go through time. Now, if we look at taxes here, so for their tax strategy, what I have here is we're comparing different Roth conversion strategies, simply put. And, like I said, there's no silver bullet here. We've made some assumptions about income, about tax rates, and now we're looking at kind of different distribution approaches and or Roth conversion approaches. So right now I've got kind of a rule of thumb, take money out of taxable, then tax deferred, then tax-free money. Well, this client only has tax deferred money, so they're just jumping right into that. And as you can see, based on current law, et cetera, they're looking at paying an average tax rate of about 22%, 21.99 for total taxes of $2.2 million. And with a total net income of $5 million over their retirement. So just, mathematically, we can see, holding assumptions constant, the impact of different approaches. And so you can see here, we have some of these Roth conversion strategies here, converting up to 12%. K doesn't really provide, we're not going to get, anything out of there really. Converting up to the first Medicare surcharge bracket. It's kind of a shadow bracket. Okay, that's going to provide probably a little bit of tax benefit, lowering taxes paid, and even increasing, keeping net income constant, and even increasing, the net legacy. I can tell the color's kind of difficult to see there. So if we keep going down, 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 you can see here that we're really trying to balance this here, the software's identifying, converting up the 22% bracket is maybe kind of the sweet spot. Well, it's not black and white here. That's giving us kind of the optimal, or that's giving us kind of the, highest legacy overall. But that may not be your priority. So, because if we look at some of these other conversion approaches, these are likely going to result in a lower effective tax bracket, converting up to the 24% bracket or even the 32% bracket, which is quite interesting. I think what this really speaks to is the benefit of avoiding those Medicare surtaxes. So if these retirees do a bunch of conversions right up front and kind of rip the Band-Aid off, as it were, they will avoid a lot of that Medicare surcharges in the future. Okay, so I'm going to go with a strategy. Let's kind of choose a middle one here. Let's go with Roth conversion at 24%. We're going to apply that. Now, we're going to look here at 24%. And now let's compare that with, in this scenario, client, they have a planned spending of $12,000, but once they hit into after 7.5, they're going to take $2,000 of that planned spending, and that's going to go towards, that's going to go to charity. So if we make that assumption, okay, so now we're comparing this plan, we're comparing essentially the same income plan, but in one scenario, they're going to do qualified charitable distributions after age 7.5. Now, required distributions, RMDs, do not start, depending on when you were born, either 75 or 73 or 75 years old. However, you can start doing QCDs back at the old RMD start age of 70.5, which is, so just so you're aware. Okay, so comparing these two, both of these plans using a 24% Roth conversion approach, you can see that by doing these charitable contributions, interestingly enough, this is going to save the person, projected to save them about 1% taxes and their effective tax rate, saving them about $150,000 of taxes paid. Now, their net income, we're still, the same net income both ways. But also interesting, we're talking about, now this is what's quite interesting, is that, if your strategy is maybe to maximize your impact or your legacy to family or to whoever, which I will just tell you, most of the retired people that I meet with, it's kind of funny. Maybe because I'm a younger person, I'm always putting emphasis on, hey, you can leave a lot of money to your children. I'll just tell you that most of the folks that I meet with who are about to retire or who are retired, most of them are somewhere on the spectrum of saying, hey, we want our kids to work and, figure things out, make their own way. Or they're of the opinion of like, hey, we're willing to help a little bit with school or, things like that. And, we're okay leaving money to our kids, but it's not the priority. We want to make sure that we are good. And then if there's something left over, okay, then it'll go to our kids. But that's generally how things work. So making this video, I'm kind of having this realization. I'm putting a bunch of emphasis on leaving money to your children. And for many of you watching, that's probably not the biggest priority. All that being said, it is part of the math. It's part of the equation or part of the consideration here. So for this person, by simply doing these qualified charitable distributions, they're saving about $150,000 in taxes during their lifetime and potentially leaving a lot more to their loved ones or whomever after they pass away. Now, with this, I think probably the best comparison for tax planning with this would actually be to say, let's compare somebody who is going to donate to charity. Either they're going to donate to charity regardless. It's just part of what they're going to do. And then say, okay, what's the impact of doing it properly through a QCD versus not? And this tax analysis is perfect for that. You can see where somebody, even with a large amount of pre-tax savings, there are absolutely tax planning strategies to be had, even in this kind of maybe what you'd call an extreme scenario where all of their savings came from pre-tax accounts. Now, I want to give one caution. I talked about things that are good, kind of general good planning strategies for when you're, early in the phase of your retirement and later on. Let me talk about something I've also seen a lot from people is they learn about Roth conversions and they're like, man, this is awesome. Maybe they're still working for a year or two or wherever they're at. And they say, man, I'm going to do a bunch of Roth conversions right away so I can get some Roth money or whatever set aside. Well, if you're still working, you need to be careful about doing that because you are adding that conversion amount on top of your current income. I'm not saying that this is the wrong thing to do. I'm just saying before you do it, you run the numbers because, it might make sense for you to do it or to do less than you were thinking, maybe even more, probably less if you have, you're working, you still have income. And it might make the most sense to wait a year or two when you're not working anymore and then do large conversions then. So it's not to say that you shouldn't do it. It's just, one of the kind of underlying planning themes is don't just make a massive financial decision without running the numbers first. It's just underlying all of this. When I was in the Army, this analogy has always helped me with financial planning, tax planning, investment planning, everything. So in the Army, one of the things I learned is something called trigger discipline and muzzle discipline. So when you have your weapon, you don't put your finger on the trigger until you are certain you are ready to fire, right? Otherwise, you have your finger off the trigger, right? Because you don't want to accidentally do something that you cannot take back that has major consequences. So I extend that analogy into financial planning where we don't want to just go off half-cocked, shooting bullets around, financial planning bullets saying, oh, good strategy, bam, bam, bam. No, first, before we fire that round, you implement a strategy, first, you run the numbers, you do the analysis. It's rare that you're going to know with perfect certainty about doing this versus that is going to be a good thing. You can have a high likelihood this looks, given a lot of information, I think this is the best course. Okay. But first you run the numbers, you do the math, you look under the covers, you figure things out before you execute that strategy, because you don't want to all of a sudden say, oops, and get this massive tax bill or this something that happens and you go, oh my gosh, man, if I had just looked into this a little bit deeper, I would have realized that wasn't the best decision. Okay. So before you go off half-cocked, shooting rounds downrange, you do your math, you do your homework. Then when you're certain, then you make a decision, you do what you got to do. So hopefully this is all very helpful, and I've really enjoyed sharing this information with you. Now that you know how these tax savings opportunities apply to a substantial pre-tax savings, you'll be so much better equipped to turn your pre-tax savings portfolio into tax-efficient retirement income. If you're looking to further optimize your retirement tax plan, click the link below to schedule a complimentary one-on-one call where I'll give you tailored advice to your situation. And I'll see you in the next one.